Stock market is really fascinating. On one hand, investing in right stocks can help you create a good amount of wealth, whereas on another hand, the wrong stocks can also destroy your wealth. Now everyone talks about what parameters to look at shortlisting the right stock. Nobody really talks about what parameters to look at avoiding the bad stocks. And historically, the majority of retail investors have ended up losing wealth rather than creating it. The reason is because they end up picking the wrong stocks. Hello friends, my name is Sahil and this is my Personal Finance Academy. The beauty of stock market is that there is no fixed formula. So you can't just look at a specific set of numbers and pick the stock. If stock investment was just about numbers, then every finance or economic professor would be a millionaire. On top of that, stock investing has a lot to do with human emotions. But still, there are some basic criteria that you can look at to eliminate the wrong stock. Having said this, there can be some exceptions. So in this video, I will share the criteria I use to eliminate the wrong stocks. I have divided this video in two parts. In the first part, we'll look at the past performance that is based on financial data. And in the second part, we'll look at the future prospects based on qualitative data. But before we proceed, this video is only for long-term fundamental investors and not for short-term traders. And I recently came to know that there are two fake Telegram channels with my name. In fact, one of the channel has 1000 plus subscribers. They are spamming with crypto related messages. Please do not subscribe to these channels. My official Telegram channel is named Sahil Bhadviya Personal Finance Academy and it has 9000 plus subscribers. Alright, let's get started with today's video. My first elimination criteria is I avoid volatile growth or low growth stocks. I like companies that grow on a consistent basis year on year in terms of both revenue and profit. Sure, there can be exceptions where the revenue or profit falls for a couple of years, but I generally avoid companies with highly volatile revenue and profit. I don't like companies that show 100 crore revenue in first year, then 50 crore in second year, then 110 crore in third year, and 40 crore in fourth year and so on. This also goes for profits. For example, the cyclical sector stocks are generally very volatile. Then I also avoid companies with consistent low growth in revenue and profit for a long-term period. Second criteria is I avoid stocks with low or negative profitability. Profitability is measured in terms of ROE and ROCE. I avoid companies with low or negative ROE and ROCE. Although there can be exceptions where the company is in a growth phase and spending heavily on capturing market share. For example, all the new age tech IPOs like Nykaa, Zomato, Paytm, etc. have negative profitability. But it is not that they are bad stocks. In fact, majority of them are among leaders in their sector. My only problem with these new age tech companies is their exorbitantly high valuations. Generally speaking, I avoid companies with ROE and ROCE of less than 10 to 15%. But please note that you can't consider banks and other financial institutions for ROCE as this metric is not applicable on their business model. Third elimination criteria is high debt to equity. I generally avoid companies that are debt heavy with debt to equity ratio more than 1. The reason is when the company takes a lot of debt, it has to pay a lot of interest. That interest eats a lot of profit. And in case the company doesn't perform well, it still has to pay that interest. That sometimes result in bankruptcy. For example, Adani Transmission has a debt to equity ratio of 3, which is very high. Tata Communication has a debt to equity of 43.8. There are many examples. Generally, companies that are involved in infrastructure sector that requires heavy investment have high debt levels. I like companies that are asset light and do not require a lot of debt. The lower the debt to equity, the better it is. And best case is negligible debt levels. Fourth elimination criteria is share pledging. I completely avoid companies where promoters have pledged their shares. Share pledging basically means that promoters have taken loans from bank by putting their stocks as collateral. For example, GMR Infra promoters have pledged 64.8% share. Suzlon promoters have pledged 88.5% shares. There are many examples. I simply avoid such shares. Although there is one exception of Asian Paints where promoters have pledged 7.9% shares. Then fifth elimination criteria is low promoter holding. I generally avoid companies with very low promoter holding, especially when the company is small with a low market cap. But again, this can't be generalized. For example, Infosys promoters have only 13.12% shareholding. So you can't just avoid Infosys based on shareholding. Then ITC doesn't have any promoter holding. Then CDSL has only 20% promoter holding. Then majority of new age tech IPOs have very low to negligible promoter holding. For example, your Paytm, Zomato, Nazara Tech, etc. have very low promoter shares. These new age tech companies have ended up diluting their stakes to raise capital for growth. Number 6 elimination criteria is penny stocks. Penny stocks don't mean that only the share price is low. It means both share price and market cap are very low. I avoid penny stocks because penny stocks can be easily manipulated by operators and they can be highly volatile. Moreover, since majority of penny stocks are very small, it is very difficult to get enough information to research before investing in penny stocks. Now when there is a bull run, some penny stocks jump 10 times, 15 times and even more. But the same penny stocks also crash 80% to 90% during the bear market. There have been many cases where retail investors fell into the trap of penny stocks and ended up losing their money. Sure, there can be some exceptions where the company is fundamentally strong, but majority of penny stocks are driven by operators, and since they have very small market cap, they are extremely volatile. And majority of penny stocks end up destroying investors' wealth. Hence, I avoid penny stocks. Number 7 elimination criteria is poor cash flow. I avoid companies that have very low working capital or negative working capital. So working capital is the money you need to run your day-to-day operation. If a company has negative working capital, then it means it doesn't have enough cash to run the day-to-day business. And in any business, cash is the king. Not literally the cash, but the liquidity to run the business. For example, let's say you have a manufacturing business and you have a fixed cost of rupees 10 crore. That could include your payment of raw materials, salaries, electricity bill, bank interest, etc. Now let's say you need to pay this money in next 1 month. And let's say you sold product worth rupees 20 crore. So your profit is rupees 10 crore. But what if your client pays you the money after 3 months? In that case, in spite of making a profit of 10 crore, you don't have the cash to pay for your raw materials, employee salary, bank interest, etc. And that is due in the next 1 month. And you will receive the money in 3 months. That creates a cash crunch. Now if you look at the FMCG companies or retail companies, one of the reasons why they command high premium is because they have very quick cash conversion cycles. It means they quickly get the money after they raise the invoice, and that money is again used to run the business. However, companies that have very high debtors day generally face the working capital challenge. And no matter how much profit you have made on the paper, if you don't have received the cash in hand, then you can't run your business. So I avoid companies with low or negative working capital. Final criteria is high valuation. This is probably the most important and most difficult part. Generally, the retail investors take care of all the points we discussed before, but one area where majority of people make mistake is valuation. That is, they end up investing in stocks at high to very high valuation. In fact, sometimes even I end up making this mistake. The major reason behind this mistake is FOMO, that is fear of missing out. If a stock is looking promising and the share price is increasing, people end up investing in the stock at any valuation. For example, look at Sona Comstar. That stock recently had an IPO in June 21 at price band of rupees 291. And guess what? This stock touched a high of 840. That is almost 3 times before it corrected around 15% from its peak. At its peak, this stock was trading at a PE ratio of 226 and currently it is trading at a PE of 206. Then there are many stocks that are trading at high valuation. But you can't just avoid a stock at high PE. You also need to look at the earning growth. It means what rate the earnings are growing. If the earnings are also growing at a fast rate like CAGR of 25 to 30%, then it makes sense to pay a premium. The only question is how much premium is good enough. For example, Affle India is trading at a PE of 80, but its earnings are also growing at a CAGR of around 60% in last 4 to 5 years. Then Dixon Technology is trading at a PE of 172 and its earnings are growing at 35% CAGR in the last 4 to 5 years. So at this earning growth, Dixon would surely command a premium valuation. But is it worth a PE of 172? Well, for me, that's overvalued. But then you might ask, stocks like Dixon Technology are never available at lower PE. So what should you do in that case? Well, you have a few options. First option is you wait for the right time. In the bull run, quality stocks will always command a premium. But in the bear market, the stock valuation would certainly reduce. For example, the same Dixon Technology was trading at a PE of around 40 to 45 during 2018 to 20. But yes, you will never know when Dixon Technology will come back to such levels again. If you don't want to wait, then one of the options is to invest systematically either on a periodic basis or on an every dip. In this case, you will invest when Dixon is at high valuation as well as when it is at lower valuation, and you will average out your returns. But again, there is no fixed rule for valuation. Like I said, you need to look at the past earning growth as well as future earning growth potential. And it doesn't mean that a stock available at a PE of less than 15 or 20 is always cheap. So it is very tricky part. But generally I avoid stocks with PE of more than 40 to 50 unless they are growing at a very fast rate and have a very bright growth prospect. So far we discussed the qualitative data, that is the financial data based on historical performance. But it is also very important to gauge the future growth prospect. Although it is difficult to gauge the future growth because the majority of parameters are subjective. But still, I look at few parameters to gauge the future prospect. So my first elimination criteria to avoid stock is weak economic moat. For a business to survive and grow in the future, it needs a thick economic moat. That is competitive strength that can't be copied easily. If there is no moat around the business, then business can face stiff competition and that can result in fall in market share and overall profits. So I avoid companies that do not have a strong economic moat. Generally, I look at the brand name, then I look at the market share, then I look at the distribution network of the company, then I look at the financial strength. If a company doesn't have a reputed brand name or a high market share or strong distribution network or strong financials, then I avoid the company. Then within software and technology business, I look at the intellectual capital in the form of patents. I avoid a tech company that doesn't have any patents. Then second elimination parameter is poor promoter pedigree. If the promoter or senior management of the company don't have enough experience or required qualification, I avoid the company. Although there is one very important parameter while looking at the promoter and senior management is their ethics and morals. But it is something that it can't be measured by simple research. But I try to avoid companies where the promoter or senior leader have been involved in the fraudulent activities in the past. Then third elimination criteria is poor future growth prospect. Whenever I look at a stock, I try to do some research around the sector in which the company operates. I try to understand the future growth prospect of the company. I try to figure out the quantified research that says this sector is expected to grow at X CAGR for the next 5 to 10 years. Then I look at the key growth drivers. I avoid companies with poor future growth prospect or companies that operate in sectors that have a very small TAM, that is total addressable market. So in this video we discussed the key parameters I use to avoid investing in wrong stocks. And like I said, it is not just one parameter but multiple parameters. So if I summarize, on the financial side, the first elimination parameter is volatile or low growth ratio. Second parameter is low or negative profitability. Third parameter is high debt to equity ratio. Fourth is share pledging. Fifth is low promoter holding. Sixth is penny stock, then low working capital, and eighth parameter is high valuation. Now on the qualitative side, I avoid companies with weak economic moat, poor promoter pedigree, and poor future growth prospect. But as I mentioned, there can be some exceptions. Now tell me in the comments, did I miss any other parameter? And what are your parameters to avoid bad stocks? In case you want to learn in detail about your stock fundamental analysis, how to pick the right mutual funds, how to select right insurance, tax planning, etc., I have a complete course on money management. I hope you will like this video. I'll see you in next video. Till then, take care.